While the TSX yesterday was trading up to a new intraday all-time high, U.S. stocks were also on the rise. The S&P 500 ended the day just half of 1 percentage point below the peak it reached in late July, and stock index futures are indicating a higher opening this morning. Let's go to Chicago for some perspective on all this. Joining us is Paul Nolte, Senior Vice President and Portfolio Manager at Kingsview Asset Management in Chicago. Paul, great to touch base with you again. This most recent buying has been spurred, at least in large part, by the positive signals that we're getting recently on U.S.-China trade talks. The two sides set to meet next month in Washington. China opening the way now to purchases of a couple of key U.S. agricultural products. Is this a good reason for investors to step in and start buying stocks?
You know, that's been the story for the last year and a half. We get a talk of a deal. We're talking about meeting. We don't have a firm date yet. We don't have a firm time yet. But certainly this it leads everybody to hope that we're moving in the right direction. And that's really all the equity markets need here, is a little bit of that hope. What we're fearful of and what we've seen over the past is some type of a reversal. We have not eliminated the tariffs. We've only postponed some of them, so we anticipate that we may see some of that come back in November and after the first of the year, depending on how these talks go.
Okay, it's way too early, Paul, to know whether this is a head fake or the beginning of a trend, but very recently value stocks have been starting to show some signs of life after 4 years of being out of favor, and growth momentum stocks coming off, especially the momentum stocks coming off. Do you see that continuing? Do you think it's a head fake? And what do you think investors should be doing about that?
Yeah, you know, it has been a head fake for the last 10 years. We've had these periods where it may be 3 months, could be as much as 9 months, where value outperforms for a while and then rolls back over. And actually yesterday, even a little bit the day before, we started to see some roll back to growth and away from value. Yesterday, I think the spread was about 60 basis points in favor of growth on the large cap U.S. So I'm taking it right now as a head fake until we start to see persistent longer term outperformance. We really haven't broken too much in the way of downtrend lines and the relationship between the two. So we're still looking at it as a head fake and a return back to large U.S. growth.
How exposed are you to stocks right now? What's your cash position like? Have you taken any money off the table out of stocks and into cash?
We've taken a little bit, and most of that is related to specific issues, valuations on specific companies, but it's not necessarily a macro call here. We've been sitting a little bit underweighted equities over the last 6 months, a little bit overweighted to bonds and a little bit to cash. So we're taking a look at it here at the all-time highs. Valuations, in our view, is still kind of stretched, especially if we look beyond the next few weeks and look out maybe the next few years. We can see where short-term and intermediate-term interest rates, even at low levels, have the potential to outperform the equity markets. So really, when we're looking at the market today, year and a half ago, we're roughly at the same spot.
I think it's more difficult to be a fixed income investor right now than an equity investor. Interest rates are at or near record lows. Some of it's inverted. What would you be doing with your portfolios now in the fixed income area?
Yeah, we still do like the treasury market. We do have a little bit in high yield. We're generally shorter duration versus benchmark. So even in a low interest rate environment, we just saw it yesterday with the ECB cutting rates, even though they're negative. They can go further negative, and that actually provides a little bit of capital gain for those investors. So I do think we're destined for lower interest rates still. And so I think we can still see some capital gain, at least clipping a coupon off the bond market here.
What do you think of the U.S. financials, the bank stocks in particular, as interest rates come down at the Fed? Should they, is there value there, or should they be avoided?
No, there's a ton of value there. Unfortunately, it's going to be hard to realize with a very flat yield curve and very low interest rates. And certainly they're the poster child for the value players. And part of the reason why we think we're going to return back to growth. So even though they're very well capitalized, valuations are very reasonable here, we think that it's going to be tough for the profitability picture to improve.
What would you be looking for from the Fed next week?
Fed, I think, is going to be cutting 25 basis points. I think some of the comments might be that they may slow down a little bit. I don't think there's that huge incentive right now to be cutting rates aggressively. If we look at the economic data, it's generally been on the positive side. A little tick up in inflation, but I don't think it's enough to keep them on the headlines for this meeting. But I think looking forward, the U.S. still has a pretty good economic picture, and I don't think it warrants a 50 to 100 basis point cut that many are calling for over the next 12 months.
The biggest value sector to me out there is the energy sector. It's severely underperformed the price of oil. What's your feeling towards the group?
Yeah, that's been a tough one. You know, we've had energy prices kind of stuck in a range here between $50 and $60. And you're right, it's been a tough go for the equity investors. But we really don't see energy going out of that range. I think the OPEC is happy with it in that range. I don't think they're really pushing to get it much above 60. And the U.S. is the other side of that. We're producing an awful lot of oil, so we can see pressure on the downside. So those two countervailing forces, I think, are going to keep energy in that 50 to 60 range. It's going to be hard for a lot of the energy companies to break out and start to really outperform until energy really gets above that range.
Paul Nolte, thanks a great deal, as always, for your insight from Chicago. Have a good weekend. Paul Nolte, Senior Vice President and Portfolio Manager, Kingsview Asset Management.